What's going on, guys? Welcome to the Hustle or Stay Basic channel, the Invest or Stay Basic segment. As always, I'm your host, KG. And today, as you can tell in the title, we're going to talk about GameStop and how we got here. I got a lot of DMs from you asking me, what is going on with GameStop? What is a hedge fund? What's shorting? Like, what in the world is going on? Don't worry, this video is for you. I'm going to try my best to explain it in simple terms. If you guys enjoyed this video, drop a like and subscribe. I'd really appreciate it. So let's get into it. So usually when I record a video, I spend the day before trying to do my research, make a deck or a slideshow presentation, and then the next day I record it. I tried the same with this GameStop video, and the differences between the share price has been quite drastic. So as you can tell, at the end, or yesterday, February 1st evening, I put this thing together, and GameStop was trading for $225 a share, and it was up 5,600% over the last 12 months. And today, as I'm recording it, it's at $90 a share, and it's up, I think, about like 2,100% over the last 12 months. Either way, both numbers are quite significant, and I think it's still worthwhile talking about GameStop and what it is and why it's so important right now. So what is GameStop? Well, if you're not familiar with them, they are the #1 physical video game retailer in the United States. They had a lot of stores in the 90s, early 2000s, and even now. And millennials like myself loved going to GameStop or Electronic Boutique, which they own as well, to go buy our games and, try to trade in our pretty recent games and get offered $5. Okay, so basically GameStop is a retailer that sells video games. We get that. So what's going on? Well, this sentence will basically summarize what is going on. And believe me, it can be quite confusing if you have not heard these terms before. Hedge funds have shorted this stock at a very high clip, and retail investors are retaliating. Now, if you're not familiar with any of these terms, don't worry. I'm going to explain it to you guys. I want you to come out of this video having a decent understanding of what's going on and why it's so important. So, let's go start at the very start of this sentence and find out what are hedge funds. So a hedge fund are actively managed alternative investments that may also use non-traditional investment strategies. Hint, hint, shorting, which I'll get into later. Hedge funds are more expensive compared to conventional investment funds and will often restrict investments to high net worth or other sophisticated investors. Hedge funds use several forms of leverage to chase large margins. So that's quite a bit. You're wondering, what the heck? I still don't understand it. No worries. So hedge funds are basically a group of rich people, if I'm supposed to put it in simple terms, with millions or billions of dollars that pool in their money together and use alternative investing strategies to kind of bully the market into doing what they wanted to do, and also use the stock market as a casino. So you might be wondering why I use the word casino, and it's basically because of this word leverage. Leverage is basically using borrowed money when making your investments. And, say I got $10 billion. I can go to my broker or financial institutions and be like, hey, lend me some money. I want to make some bets in the stock market. And due to the amount of money I have, I can leverage more, meaning they could probably offer me $40 billion to loan out to actually make some more bets. And by doing that, I can really bully the market. If you don't remember, 07-08 involved a lot of hedge funds overextending themselves or leveraging themselves and causing a financial crisis, which is why a lot of people are saying, they shouldn't be bailed out. And the US did bail out hedge funds in the past, but we'll get into that later. Let's get into the next term, shorting. So basically, you understand hedge funds, right? Bunch of rich people have a lot of money, bullying their way in the casino. That's my simple terms of what hedge funds are. So shorting is kind of the opposite of how us retail investors invest in stocks. We purchase an equity, and we want the price to go up over time, and eventually we'll sell out of our position when we think we've made a decent gain. So shorting is the opposite of what most of us retail investors do. Essentially what they do is they sell their security to their broker with plans to buy it later, and it's basically a technique used when they think the share price will drop. So if the share price drops, they get to buy those shares at that low price and they get the difference between that price drop. A little bit confusing. Let's go look at a real example. Say there's a company that you don't think is going to do too well and you think the share price is going to drop. Let's call it the Hustle or Stay Basic company. Why not? It's hypothetical. And let's say the Hustle or Stay Basic company currently trades today for $50 a share. If I think the share price is going to drop, I'd be selling my 100 shares. In this example, I'm going to say we have 100 shares just to make it simple, to my broker. So that would be $5,000 worth of shares. If the share price dropped to $30, that would mean that that initial sale that I did to my broker would equal $3,000. By shorting it, I would get the $2,000 return because, as you can tell, my valuation of what I purchased actually dropped $2,000, and I predicted it was going to drop. So by shorting it, I get the $2,000. So people who short stocks actually really want their equities to do poorly, so they can buy them at a cheaper price and they can get the difference in between. The difference between shorting and buying stocks, for example, if I bought $5,000 worth of these shares at $50 per share and the price went to zero, I would lose all my money. But with shorting, you can lose more than your initial investment. If the share price actually increased and went to $60, I would have to cover that $1,000 difference to my broker. And that $1,000 difference I'm talking about is that 60 times 100 minus 50 times 100. That's $1,000. Okay, still a little bit confusing maybe for you. So let's go look at what was actually going on with GameStop in terms of shorting. So GameStop has 69.75 million shares outstanding. And these hedge funds were shorting 68 million shares as of December 15th, 2020. What that means is they were selling 68 million shares to their brokers in anticipation for the share price going down. If the share price goes down, they get the difference. If it goes up, they got to cover the difference. Just as an example, if they had shorted it at $20 a share, their investment would have been $1.36 billion using that 68.13 million shares number. If the stock is currently $225, which is not, I made this deck yesterday, but if it was $225, which it was in the past, they would have to cover the difference since the share price went up from $20 to $225, exactly the opposite of what they wanted to do when they're shorting stocks. What that would mean is that the hedge funds would have to pay $13.96 billion out of their pocket, which is an absolutely insane number. That's a minus 1100% return. Now, in real life, there was actually a point when 130% of GameStop shares were being shorted. And that might be confusing, but it was due to something called a naked short, not a covered short. And what I've been sharing with you guys is a covered short. So I don't want to confuse you anymore, but basically, I think you guys understand what a short is and how it works. So I want to keep on moving on. With that said, I want to introduce you guys to the dream team, the retail investors that have caused these hedge funds to lose billions of dollars. They are the Wallstreetbets. So if you're not familiar with Reddit, it's basically a forum where you can talk about anything. This forum is actually called Wallstreetbets, but there's different chat groups. You can go talk about cars, basketball, anything you're interested in. You can find a bunch of people talking about it. But this Wallstreetbets group is actually composed of 8.1 million, they call themselves degenerates. And I'm not going to get into what FDs is, but if you want to go look it up, go look it up. These are retail investors like myself and probably yourself who, feel their thousands of dollars aren't really going to move a market of millions and billions. But when you got 8.1 million people aligned to do the same thing, you can move the market. A lot of the members in this group are wild and don't mind losing any sort of money. And a lot of them actually lose several thousands dollars worth of money every day. But they're also a very passionate group of individuals. As you can see, one of them actually bought a billboard in New York saying, GameStop's going to the top, etc., etc. So why would this group of degenerates try to fight hedge funds? What do they got against the hedge funds? So number one, I think they realized that GameStop was shorted at a very high level, and they didn't like that because when hedge funds short a company, they basically dictate the market. They say, hey, this company should be no longer, it should go down. And essentially, if you go and invest in a company and you see it's being shorted 80%, you don't want to invest in it because you know that company is probably going to start trending downwards more than upwards. Like I said, these hedge funds bully retail investors out of stock positions all the time. So let me lay out the equation for you guys. You got retail investors, Wallstreetbets, who lived through the financial crisis and saw their parents lose jobs, lose their houses, but hedge funds get bailed out. And then you got this company GameStop that these retail investors, Wallstreetbets, love. And then you got these hedge funds shorting the company they love. So it made perfect sense for these retail investors to, group up and attack these hedge funds. And how can they do that? They can do that by driving the price per share of GameStop up. By driving the share price up, they'll force the hedge funds to cover their losses. And who knew that 8 million people with thousands of dollars, not millions of dollars, thousands of dollars in their accounts could move the GameStop share price up and make these hedge funds lose a lot of money. I got this article from a week ago when I think GameStop was actually over $300 price per share. And it shows that the short sellers are nursing estimated losses of $19 billion due to these retail investors pumping up the GameStop share price. Wallstreetbets, aka the retail investors, after realizing they could actually move the market and cause hedge funds to lose money, they started looking at other companies that were shorted at a high clip. Guess what they did? They drove those prices up as well. Here are a couple of them. I have AMC, which was, about $2 a share, and they drove that up to $13 a share. I have Express, which was 93 cents, and they drove that up to $5 a share. FIZZ, National Beverage Corp, that was under, it looks like $84 a share. They drove that up to $132 a share. They were making these hedge funds lose a lot of money. How much? $70 billion worth of money. And I absolutely love this meme. We got the hedge fund saying, we lost 70 billion, and then Wallstreetbets saying, you lost 70 billion so far. Like, we're not done with you guys yet. We're really pissed off. And if that wasn't enough drama enough, Robinhood, which is the most popular investing app between millennials, started to say, hey, you cannot buy any more GameStop shares. And it just created a whole another level of like, this is the super rich versus the retail investors. That's what's going on. Basically, what Robinhood said is if you own GameStop shares, you can sell them, but we won't let you buy them. And that created all kinds of drama. Like, how can an app dictate what I'm doing in my investing life? Like, if I want to buy GameStop, I should be able to buy GameStop. You're letting hedge funds short GameStop, but you're not letting me buy shares? That sounds awfully rigged to me. And a bunch of people chimed in on that, including Elon Musk. Robinhood tried to downplay it, but luckily we got some good news here. The Robinhood CEO is expected to testify before the U.S. House Committee on February 18th on why exactly he stopped GameStop shares from being purchased in the Robinhood app. Okay, so that was a lot. Now we're back at the first slide. Hedge funds have shorted this stock at a very high clip, and retail investors are retaliating. Do you understand that sentence now? I hope you do. Basically, the super wealthy are hoping a company will go down the drain and they'll make a lot of money off of that. But retail investors are stepping up, aligning together to drive the share price of a company up, thus causing these hedge funds to lose a lot of money. I hope that makes sense. I hope you found this video simple and easy to understand. If it was still complicated or if I said something wrong, let me know in the comments below. Always looking to clarify. And I hope you enjoyed this video. For anyone who DM me at KG the Hustler on Instagram, I hope you enjoyed this video as well. And I'll see you guys later. Bye. See ya.